As 2021 kicks off and many investors are looking for the next unicorn, much like many that were given to us in 2020, what about the more traditional investments that distribute their earnings to investors? In this episode, I discuss two large cap companies that have some of the highest paying dividends in the market that you should consider for 2021. Hello, you wonderful people out there. My name is Chris, and welcome to the Business Report Show, where I give my insights on the world of business and investing. Hope you like the blue shirt. I clearly like the color blue. Couple things before we begin. I'm working on a video series to walk you through how I'm building my $1 million portfolio for retirement. So make sure you click the subscribe button below to get notified when these videos and other videos I'm making are uploaded. Now, second thing is, everything I discuss in this video are just my opinions. There are no guarantees of success. Always seek professional advice before investing. Now, simply put, dividend stocks come from companies that pay investors a certain amount per share, either monthly, quarterly, or annually, or a combination thereof. Companies that pay dividends are well-established companies with a track record of distributing net profit back to shareholders. Take a company like Johnson & Johnson, whose product brands include Band-Aid, Tylenol, Neutrogena, and much more. They have a record of paying dividends to investors consecutively over the last 57 years. 57 years, seriously, such a long time. So that means through the savings and loans crisis in the 80s, the dot-com bubble in the 90s, even the financial crisis of 2008, and through to the global pandemic, J&J has continually paid a dividend to its investors. Now, based on their most recent stock price, it pays an approximate 2.58% dividend, which accounts for approximately 35% of its estimated cash flow, which is often called the payout ratio. Now, the actual amount distributed per share may fluctuate from year to year, depending on the cash needs of the company, but most companies try to keep it consistent, as any large fluctuations downward may hurt the stock. One other angle investors should consider when it comes to buying dividend-paying stocks is that while investors are earning a quarterly dividend from Johnson & Johnson, in my example, the stock price 57 years ago in 1963 was 6 cents per share, adjusted for all the stock splits that's happened. Today, that stock is now trading at $156 per share, meaning that if you held on to J&J for the last 57 years, you would have had an approximate equity return of 261,000% in addition to all the dividends you would have accrued throughout that time. So as you can see, there can be some exponential returns when owning dividend stocks, as you're gaining returns from both the equity and cash payments. All right, now that I've gone over at a high level what dividends are, here are two companies that currently have some of the highest dividend yields on the market. So the first company I want to talk about is AT&T, ticker symbol T. As most of you know, or even perhaps are customers of AT&T, they are a holding company made up of 4 segments. All in all, AT&T derives its revenues from multiple sources, from content development to content distribution, and they do have a track record of paying their dividends since 1984. Now, based on the current stock price of $28, AT&T has an annual dividend that yields an impressive 7%, and it's probably going to attract investors who may be ready to sell their high growth stocks that they've gained so much in 2020, and they may want to rotate that into something a little bit more stable and something that can generate some passive income off those massive equity gains. AT&T pays a dividend in quarterly chunks, and they've been increasing their dividend payments ever since 2006, except for last year, which did not impress the market and is one of the many reasons why their current share price is lagging its competitors. AT&T hasn't really recovered from the massive drop in 2020 when the global pandemic hit. Its share price fell from $38 down to $26, currently sits at around $28.75 as of January 12th closing. It managed to get close to $31 in December, but that's about it. So for some investors who may have held it since last year or longer, the high dividend rate is not enough to make up for the 26% drop in share price. So clearly there are some concerns, as high quality big cap stocks offering such a high dividend should have income investors pouring in. The first concern is that their payout ratio from net profit, which is all the revenue they generate minus all the costs, their dividend payout is equal to 137% of that profit, which isn't ideal. As a rule of thumb, anything above 100% should be a concern. So how exactly are they paying for this? Well, their free cash flow is quite healthy, especially when you think about where their incoming cash is coming from, like monthly subscriptions from retail and business customers. When you look at the payout ratio compared to their free cash flow, it's around 54%, which makes this metric a little more palatable. But ultimately, what this means is that it is hampering their ability to funnel more of that free cash flow into building up and investing into their business. This leads me to some of the potential issues AT&T is facing from a business perspective. Its legacy landline business continues to fade, and its satellite business DirecTV is also shedding subscribers like it's going out of style. Like literally, it's going out of style. Now, of course, over the last few years, they pivoted from that business segment and they're focused on premium video and made-for-digital content through the DirecTV brand, but the competition is stiff and they are a little bit behind. With many theaters closing in 2020 and a recent public spat with the movie theater cartel, their Warner Media theatrical releases took a hit and the launch of HBO Max didn't quite get the traction they were hoping for. That being said, I think many production companies are seeing the value of releasing straight to streaming, and this may prove fruitful for AT&T in the future. Now, remember how I mentioned that the dividends may hamper investment into the business? Well, AT&T is lagging behind its rivals T-Mobile and Verizon for 5G rollout. T-Mobile is building its ultra-capacity 5G network on the back of its spectrum that they acquired through the merger with Sprint. The FCC is currently auctioning off another set of spectrums, but rivals like Verizon, they have a much larger cash reserve to play with. AT&T is likely going to have to settle with lower block licenses in this spectrum, which means their 5G rollout isn't happening till 2023. What is there to like about AT&T? Well, first off, it is a well-known company with a solid history of dividend payouts and revenue generation. While revenues have slightly dropped and net income has followed suit, their diversified business holding means there are opportunities for AT&T to recover and move to a positive revenue growth direction. Any new blockbuster movie hit or continued consumer shift to streaming TV should benefit AT&T, but it's a matter of where they can win over more customers and minimize the churn rate of existing customers. I think for income investors, AT&T should be an attractive stock for 2021. Do look for signs of continued quarterly revenue drops to play this one tight, as there are definitely other high dividend yielding companies to choose from. All right, the second company I want to discuss is MPLX Limited Partnership, ticker symbol MPLX. For full disclosure, I did buy this stock in December to add to the dividend portion of my value holdings. MPLX LP is a master limited partnership formed by Marathon Petroleum Corporation to own, operate, develop, and acquire midstream energy infrastructure assets. For those unfamiliar with the industry is split into three segments: upstream, midstream, and downstream. Midstream includes companies that transport, store, and provide wholesale marketing of crude or refined petroleum products. MPLX is a massive company from both a market cap standpoint, but also an operation standpoint. Their market cap is at $25.8 billion, and their assets include a network of crude oil and refined product pipelines, an inland marine business, light product terminals, storage caverns, refinery tanks, docks, loading racks, associate piping, crude and light product marine, and it goes on, but their infrastructure stretches over 17 states. Now, based on the current share price of $24, MPLX has a dividend yield of, get this, 11%. And in fact, in one point when the oil stocks took such a big hit in 2020, their dividend yield was at 16%. So how does MPLX pay such a high dividend? Well, as a master limited partnership structured company, it is required to pay out all of their cash on hand, as the company itself is not subject to any tax, and the tax is taken upon the distribution to individual limited partners like myself who holds the units now. Of course, the company can offset some of that cash, and they always do, on capital expenditures and to grow the business. I have to say, MPLX is a unique case study for me, as some calculations show that the stock price is actually about 36% undervalued, and in fact, management has set aside over $1 billion to buy back limited partnership units because the units are so undervalued. Now, despite the hit to oil and gas market in 2020 due to the global pandemic, MPLX managed to keep revenue steady. In fact, Q3 2020 saw a 4.9% year-over-year growth in EBITDA and 3.9% increase in distributable cash flow. As a large cap midstream company, debt is expected to be high during times where they are building infrastructure. on the books is close to $20 billion in long-term debt, but net operating income is more than enough to meet the interest payments. A lot of debt they took on was to complete projects such as a large 1.8 billion cubic feet per day expansion of their joint venture Agua Blanca pipeline system. Testing and commissioning of the expansion started in November of 2020, with the system anticipated to be brought into full service in early 2021, which means this capital-intensive project will begin cash flowing nicely for the company and unit holders. Now, another positive news: at the end of December, the company announced the redemption of $750 million worth of senior notes that were actually due in 2025. You're probably wondering at this point, Chris, seems like the perfect stock. Why aren't investors rushing into this gem? Well, frankly speaking, the investment market has essentially stepped away from oil and gas stocks as the global pandemic and the growth of the electric vehicle market is starting to put doubt in long-term institutional investors as to whether or not oil and gas stocks are worth holding onto. It was a year ago that Marathon actually had to write off $1.2 billion in goodwill just for canceling a pipeline project and a series of other planned projects related to their midstream business. We are, however, seeing some investors limp back into oil and gas stocks as of late. A lot of Canadian oil and gas stocks I used to own are starting to make a little bit of a comeback as valuations are severely undervalued compared to the cash that they're generating even at low oil prices. While it's hard to ignore the increased share of electric vehicles and auto sales, one portion of MPLX's business is one of the main reasons why I've added this stock to my portfolio. As the world transitions to cleaner energy, natural gas will play a huge role in this transformation. On the surface, natural gas is often seen as the cleaner alternative amongst the various hydrocarbons we use. In fact, there are government dollars in North America right now earmarked for growing the natural gas industry to support transition to clean energy. Of course, natural gas is a necessity to heating homes in colder climates, but the future of natural gas is also in the production of hydrogen. Natural gas reforming is an advanced and mature production process that builds upon the existing infrastructure of natural gas pipeline delivery infrastructure. Today, 95% of hydrogen produced in the United States is made from natural gas reforming in large central plants. This is important technology pathway for near-term hydrogen production. So what is hydrogen's role in this new clean energy future? Well, hydrogen is the fuel source for fuel cell energy production. Fuel cells combine hydrogen and oxygen together to produce electricity, with the main byproducts being heat and water. Current battery technologies are not yet practical for transportation such as large passenger trains, commercial freight vehicles, and even public transit. The solution to this is hydrogen fuel cells to produce electricity, which then powers electric motors. The other usage for hydrogen fuel cells is to provide large battery backup for major power grids. Recent developments in Tesla's grid battery station is great, but hydrogen fuel cell battery backups are more practical for our current electricity grid in terms of meeting demand and scale. I think MPLX is in a strong position to take advantage of this growth in hydrogen demand for the foreseeable future. Now, of course, as with all energy-related stocks, it is quite volatile, and if the oil and gas markets take another hit this year, you can expect this large dividend to be decreased to reflect cash flow realities. Just like AT&T, if you do end up adding this stock to your portfolio, you will need to play it tight and keep a close eye on commodity prices and adjust your holdings accordingly. Well, that's it for today's video. Don't forget to hit the subscribe button, and if you enjoyed this video, make sure you hit the like button. Every little bit helps. As mentioned, everything said here is just my opinion. Always consult a professional before investing. Also, leave a comment down below, as I want to get your take on high yielding stocks that you may be holding or eyeing for 2021. Thanks again for taking the time to watch the Business Report Show. Remember, always be learning, always be investing. I'll catch you next time.